The Zacks rank, value, momentum, growth, and income all factor into Zacks rank buys.
Well, leisure is the watchword when it comes to growth and income stocks, at least for purposes of this segment. And our strategist, Ryan McQueeney, is going to tell us why he's chosen one stock in particular. I can't wait to hear your story on Wynn Resorts, considering that we have it currently, as we speak today, a strong sell, but the momentum score is an A.
Yeah, so the strong sell hinting to us that the earnings outlook wasn't so strong. Several negative revisions for the just reported quarter heading into that announcement yesterday afternoon. That ended up being a pretty clear indicator of what was to come. A disappointing report for Wynn. Earnings of $1.68 per share, missed the Zacks consensus estimate by about 9 cents. There was still some growth there, up about 10.5% year over year. Revenue was above estimates at $1.7 billion, up 6% year over year. And these casino stocks like these are typical or popular income picks. So when we talk about these growth and income stocks, seeing 10% bottom line growth, a 2.6% dividend yield, that's something that might come up on a growth and income person's radar. Certainly always on our radar. But we're seeing some really concerning trends with Wynn and with really all of these Las Vegas and Macau casino giants. Specifically, the new CEO warning us that there has been a slowdown at the Macau location, and that's because of kind of a pullback, a softer demand, softer activity from these premium gamers, these high rollers, if you will. And that trend, according to management, is extending into the premium market in Singapore and Las Vegas as well. And so that's where we tell a little bit more about the story of Wynn. Before we get into that and kind of what it tells us about the rest of the casino giants, I do want to just show the gap down in the shares. The stock absolutely plummeting after that report. Double-digit percentage drop, as we can see here. This is what we call a gap down. Quite the gap there on the one-day chart. Investors really not liking what they heard from management, those things I just mentioned. And with Wynn, shares were down already 30% heading into the report. We see this significant gap down here. The issue has been a couple things. First, those trends that I mentioned in Macau and Las Vegas have been kind of apparent all year, and they've been really weighing on gambling stocks and casino stocks. The other issue here, too, is Wynn is trying to move past a really horrible situation involving its namesake and former CEO, Steve Wynn. A lot of sexual misconduct allegations, sexual assault allegations against Steve Wynn, which is of a particular problem to a company named after him and with his signature up on all of its marquee properties. So, a combination of the specific problems affecting Wynn Resorts and the negative trends in gaming, and this, the floor totally falling out of the stock after the earnings is telling me stay away from it for now.
But there's still that momentum score of A. So what do you think? Turnaround candidate or total crapshoot?
I would say, without having looked at the grade specifically, I would say probably what's happening there is looking into the future, because we incorporate the earnings trend into the momentum grade as well. I would say probably what happened there is for future periods there was a positive earnings trend. That was obviously outweighed by the near-term things. That's why you're seeing the Zacks rank the way it was. Right now, I don't see much of a reason to touch this particular stock, which is kind of why the second stock is on our radar today too, because it's also in this casino business.
Right, gaming and leisure properties.
Yeah, so the ticker there is GLPI. I wanted to highlight it because, I think, as I said, this casino and gaming business is something that comes up on an income investor's radar a lot. And I think if you want to still have exposure to this, this is a much better option.
Okay.
And so it is a REIT that owns casino properties. Wynn Resorts is a casino operator. So that's where the difference is. And specifically, Gaming and Leisure Properties owns mostly regional gaming facilities and then leases them out to regional gaming operators. So think Penn National Gaming, Boyd Gaming, Eldorado Resorts. Those are the people leasing Gaming and Leisure Properties, if you will. I believe it was actually a spin-off of Penn National Gaming a few years ago.
Okay.
And what that does is it fixes two problems right off the bat. First of all, it gets us away from that premium gaming business in the huge hotspots that have been trouble for the casinos there. So we're not in Macau, we're not in Las Vegas with this stock. Plus, these companies operate on contracts with the people that are leasing their casinos. So a near-term or a short-term pullback and a slowdown over a few quarters really isn't going to affect its business model per se. So it fixes the two key problems there. The key with any REIT, which I want to look at now, is first fundamental thing we want to see is stable or growing funds from operations. On the Zacks.com website, we actually list funds from operations for REITs instead of earnings. And so this is a Zacks ranked #1 strong buy because we are seeing an uptrend in its funds from operations outlook. As we can see here, really coming in strongly over the last couple of months. We're seeing a strong uptrend, but we haven't quite seen the stock respond to that yet, which tells me there's that divergence between what the earnings trend is doing and what the stock is doing, which tells me it could be an interesting time to buy. And then, growth in income stocks, we're always talking about where is the growth coming from here. As we can see here, not a ton of earnings growth. The gap between these lines would tell us growth in that funds from operation or which is a key metric for profitability. But revenue growth is the story here. Has a great acquisition history, continuously bringing in new business. We're seeing strong growth on the top line, 9% expected this year, 21% next year. And it's a REIT with a really, really healthy payout, increases the dividend every year, 7.5% yield right now.
Okay, sounds good. Do you own either one?
I do not. And we have neither in the income investor portfolio service either.
Good to know. Don't forget, more information on stocks, these two companies, as well as others on our website, Zacks.com. Get on over to the homepage and begin checking it out. And also, Ryan puts together some interesting podcasts called Tech Talk Tuesdays. Those you'll find on the podcast page of Zacks.com. Don't forget his live video streaming program Monday through Thursday. Free lunch available to you on most major video streaming platforms. With Ryan, I'm Terry Ruffalo.